With over 12 years of experience in pensions and investment, I have experienced and read a number of success stories on how to build life-changing wealth through consistent, strategic, long-term investing. While the principles of wealth creation are universal, the method of execution must be tailored to the specific challenges and opportunities within each region. The problem: why most investors fail. Many investors abandon their plans due to market volatility, inflation, or economic uncertainty. In the United States, fear-driven reactions during downturns often lead to premature selling. In Europe, complex taxation and a conservative investment culture hinder long-term growth. In Africa, restricted access to global markets and unstable local currencies present additional hurdles. Despite these obstacles, history consistently demonstrates that disciplined investing outperforms erratic market timing. The solution: regional investment blueprints. Investors should prioritize tax efficiency and automation. In the USA, accounts like Roth IRAs and 401ks provide tax-advantaged growth. The S&P 500 index remains a cornerstone investment, offering broad exposure to top-performing companies. Automating monthly contributions and reinvesting dividends helps ensure long-term consistency while removing emotional decision-making from the process. In Europe, particularly in the UK and EU, investors can leverage ISAs and ETFs to grow wealth efficiently. UK residents should take full advantage of the stocks and shares ISA, which allows up to £20,000 annually in tax-free contributions with no restrictions on withdrawals. European investors can access global markets through low-cost index ETFs, such as the MSCI World ETF, using platforms like Interactive Brokers or Trading 212. Automation tools offered by these platforms further support consistent, hands-off investing. African investors must contend with currency risk and limited local investment options. However, options like bonds and equities are a viable option. The strategy can also involve investing in dollar-denominated assets via international platforms such as eToro or Interactive Brokers. Regular contributions to US-listed ETFs, even in small amounts, help reduce risk through dollar-cost averaging. This approach also shields capital from inflation and currency depreciation, which are common concerns in many African economies. The power of time and discipline. Consistent investing over time yields exponential growth, regardless of market conditions. Consider someone who began investing $250 per month in 1985 and remained committed through events like Black Monday, the dot-com crash, and the 2008 financial crisis. Despite these challenges, the average annual return over this period was 11.23%, resulting in a portfolio value of over $1.8 million, representing a 6,000% return. The key insight is that downturns are temporary, but the compounding effect of disciplined investing is permanent. Starting early amplifies results. A person investing consistently from age 25 will build significantly more wealth than someone who starts at 35, even if the monthly investment amount is the same. As a real-world example, an experiment of investing £5 daily into the S&P 500 yielded a 5% return in just 3 months. Practical steps to start. Begin by opening an appropriate investment account, whether a Roth IRA, an ISA, or a global brokerage account. Even modest daily investments can accumulate substantial wealth over time. Automate your contributions to maintain consistency and reduce the temptation to time the market. Choose accumulation funds that automatically reinvest dividends to benefit from compound growth. If you are inclined to invest in individual stocks, base your decisions on sound fundamental analysis rather than market speculation, and use limit orders to manage your entry prices effectively. Why mindset matters. Beyond account types and asset selection, the right mindset is crucial. Successful investors cultivate patience, avoid emotional decision-making, and view market downturns as opportunities rather than setbacks. Building wealth is not a sprint, it's a marathon. Understanding that short-term volatility is part of the journey helps investors stay focused on their long-term goals. Adapting to life changes. Life circumstances like career changes, family obligations, or economic shifts will affect your investment capacity. The key is to remain consistent with whatever amount you can afford. Adjust your contributions, but never abandon your strategy. Even periods of reduced investment can be followed by stronger contributions when your financial situation improves. The role of financial education. Ongoing education strengthens investor confidence and decision-making. Reading books, listening to financial podcasts, or working with a trusted advisor can deepen your understanding of markets and keep you updated on best practices. An informed investor is more likely to stay disciplined and benefit fully from compounding returns over time. And what is the final challenge? Start today. Delay only reduces your future financial security. The market will rise and fall, but your success depends on remaining invested and consistent. Use the tools available to you, trust the data, and take action. The best time to invest was yesterday. The second best time is now. Did you find this video useful? Do not forget to like it and subscribe for the channel for more educational videos.